banks do have their own money, ready to pay the bills if everything goes wrong. Their capital. But it's kind of dead money. It doesn't earn a lot for them, so they don't keep very much, certainly not relative to their towers of borrowing and lending. And that means banks are innately vulnerable, which leaves ambitious bankers like Dick Fuld and Adam Applegarth in quite a bind, because the more borrowing and lending they do, the more vulnerable they are.
Banks of all types, from Lehman Brothers to Northern Rock, wanted that holy grail, a way to be highly profitable and secure at the same time. And then came along an answer to every ambitious banker's prayers. A new piece of financial technology that came out of Wall Street in the 1970s. It was called securitization.
Is there life on Mars?
Well, good question. NASA is still looking. But David Bowie can teach us plenty about securitization. Ziggy Stardust turned 62 last week. He used this mysterious concept to cash in on his back catalogue. In 1997, David Bowie simply estimated his royalties income for the next 10 years and said, you know what, I'd rather have the money now. And so he issued financial securities, Bowie bonds. He sold them for $55 million cash, and the people who bought them took the royalties plus interest in return. Everyone was delighted, and that's securitization.
Oh, the rhythm's up better on the steel guitar. You're the blessing with the spiders from Mars.
Now, rockstar royalties are one thing. Why not apply the same technique to property, to mortgages, where there are billions of pounds in money-earning loans, but which are tied up for decades? Why not turn them into a security? Essentially, it's just a piece of paper, which the bank sells to get cash now. In return, the buyer, maybe a pension fund or some other big investor, gets regular payments from all those mortgages.
For many in banking, securitization was a magic bullet. The best invention, well, since paper money. And
Dr. Charles Geist is a financial historian who studied the growth of securitization on Wall Street.
The old banking model meant that the bank or the lender would have kept the mortgage on his books and relied on it for revenue and eventually getting paid back the principal amount that they had loaned. Under the new model, bankers were now making loans not in the traditional way of gauging the financial quality of the customer, because it was going to be somebody else's problem.